CNBC-TV18. Aman Chowhan is also with us, fund manager at Abakkus Asset Management. Aman, good to have you with us here. Thanks as always for joining us. Actually, I want to pose that question, real estate, to you, which we were just discussing with Deepak. What are your thoughts? It seems like a fresh move backed by huge volumes. The index is up 5%. It's almost as if, someone is saying a fresh view or the longer-term opportunity of the sector. But is that so, or is this the pre-quarterly updates which is kind of adding to it? What's the sense?
I think it's a combination. The stocks have not moved for a good amount of time and kind of a catch-up rally. The sector anyway is doing well, right? So it's a 3 to 4 year cycle. We are probably in the second year of the upcycle. So we have another good 2-3 years of cycle to play. Plus, the view remains that sooner than later, we'll have the first round of rate cuts also coming in, if not immediately, maybe in the next 6 months or so, which will also give a further boost to the sector. And hence, the rally. And that's typical in bull markets. Every day, there is some sector which does well. Today seems to be a real estate day.
There is a lot of churn taking place, particularly in the mid-cap space. And today's flavor is clearly real estate. The Nifty Realty Index is, by the way, at a 15-year high today. But, Aman, we were chatting with another fund manager, and he said that he expects real estate to be quite the compounder. So a volume growth of about 8 to 9% every year, and add to that 7 to 8% price appreciation. So according to him, real estate could give you, earnings growth of close to about 15% from here on. So we're not, closer to the end of the cycle. He believes there was some more steam left. But you want to fill us in on some more changes that you've made in your portfolio since, there is that churn taking place in the markets?
Yeah, the assessment is right. There will be volume growth. The companies can steadily grow. What I was mentioning to the real estate prices. So we have seen that every 4-5 years, there is some price correction. So it cannot happen that every year for the next 10 years or so, there will be a 7-8% price inflation in real estate prices, right? So there is a time when housing prices correct or stagnate in many times. So that is what I was referring to. On the portfolio front, frankly, not much of changes, especially in the last month or so. We have been on the sidelines. We were adding more of what we already own rather than buying new names. There have been some IPOs that we have invested in the last month or so. Besides that, not much of churn. Specific to real estate, as always, we don't have a direct real estate exposure. We play this upcycle through the ancillaries. So we would have laminate companies, plywood companies, MDF companies, tile companies in our portfolio. So that's the way we are capturing the real estate upswing in the portfolio.
Aman, hi, good afternoon. I recall you have a fair amount of midcap exposure as well across the portfolios, right? So just wondering, in this consolidation patch, which we hit soon after touching 20,000, have you been taking profits anywhere? And if yes, which are those areas in your portfolio where we've been partly sort of unloading?
It's more stock specific than a midcap or a sectoral call. So wherever we have seen stock prices move up too sharply, or wherever the exposure limits has gone beyond what our comfort level is, we would have trimmed our exposure. So typically, we have a rule that single stock will not exceed 10% of the portfolio. If something goes around 8-9%, we start trimming that name. So that has happened in the last few months.
So, Aman, let me rephrase that question. I mean, you don't have a sectoral approach to that in your portfolio, but generally, if you were to advise someone looking at how the market is positioned right now, which are the areas where you think that themes have kind of run their course, at least in the near term, and some profit taking could be warranted? I mean, I don't know whether it's let's say PSU stocks or defense or anything else, or real estate for that matter. Anywhere where you think people should start booking some profits?
Clearly, defense and railways, these are the two sectors that have done extremely well in the last 6 months, and prices have almost doubled, tripled for most of the names. So clearly, there is some fraud there. One needs to be careful, and wherever you don't have a valuation comfort coming in, some amount of profit booking can be advised in these two sectors. Besides that, in the next few quarters at least, chemical sector is going to be volatile. So if something which is quite expensive and there's margin pressure or growth not coming in due to the global factors, then this is something which can get derated. So there's always this risk in the chemical sector, and some pockets of pharma also. There can be some derating because in the near term, numbers might not come in as strong as what the street is estimating. Financials, we are pretty comfortable. IT, we are pretty comfortable. We feel the quarterly numbers are going to be good. or better than what the street is estimating for IT as well as for financials. And that's where I can say incremental money for us is going.
All right. Hi, Aman. Good afternoon. Thanks so much for joining. And, to the point on real estate, China is going to a crisis in the real estate market. And over here, our real estate market is booming. So another point where we stand out in comparison to China. Pretty good going for us. But the other point that concerns China and obviously has repercussions for the rest of the globe is the metal space. And you all have made some perfect investments out there. The one that comes to mind first up is Jindal Stainless, where you all did quite well. You all got in at a very good time, and that's more than a, I think, 5-8 bagger for you all. But what's your positioning now on metals? Domestically, we're likely to see a fair bit of activity on the construction side, which some metal stocks will obviously be in focus. And also globally, China is talking about stimulus. Maybe the steel production slows down for the remainder of this year. How are you all positioned out there? Metals is a percentage of your portfolio. How much is it?
So we are positive on the space, but at the same time, it's not that we have a very large exposure to metals. In my portfolio would be anywhere between a high single-digit kind of exposure. In one or two portfolios, it could be 11-12%. But we have kept it limited because ultimately it's a global cyclical sector. So the stocks that we have picked are all bottom-up stocks. They all have an individual investment positive or investment thesis to go around as to why we have invested. But it's a global sector, and hence we wanted to keep a diversified portfolio. Hence, it's a high single-digit exposure for us. It has always been the case. Even 2 years back, this was the case. Even now, that's the case. So no material change in stance so far for this sector.
Okay, got it. Aman, anything new you've added in the portfolio since we last spoke?
IPOs. So it's public news. We have 2-3 IPOs that have come in the last month or so where we have invested. That would be the new additions in the portfolio.
Talk to us about one of the names, just for educational purposes. What you liked and, what was the thought process?
So we invested into Sari retailing company, which just got listed. We were one of the anchor investors there. Then we invested into it. Yeah. Then we invested into an EPC company. This was a new IPO that came in. The stock got listed, I think, 2 weeks back. So we invested into that. There was a IT product or a quasi product company which just got listed 10 days back. We were invested in that also. So these are the kind of new names that are coming to the portfolio.
Sorry, the last one, I got one. There are so many IPOs that I run the risk of getting
We're all
names
trying
wrong.
to guess someone, but not quite sure.
Is the third one Zaggle? Sorry.
Zaggle, yeah. So we were anchor investors in Zaggle also.
And which was the EPC company?
EMS.
EMS, okay. And they've all done very well since they've sort of listed. So congratulations. My question actually is, there are two. And just talk about the company and what you like. It's not a recommendation to buy or anything. Sai Silk, which is Kalamandir. When we had the management right here in the studios and we spoke with them, one of the things which generally the worry was that it's a in a way commoditized kind of business, right? There is no more. I mean, when you talk about saris, you talk about Banarsi sari or a Kanjivaram sari. You don't say a Sai Silk sari or XYZ company. I mean, so or are we, or is the call that we will get into brand building in this area as well? I mean, if you can talk about that, and then a little bit about Zaggle after that. Go on.
Because I can't discuss stock specific. Broadly, I can tell you that at a sectoral level, your assessment is right that it's not a branded sector, and that is what the opportunity is. So I'm told that the organized market is not even 10%. So there is a decent chance that for the next few years, the organized retailing will pick up in this segment also, and they'll gain market share from the unorganized. And then that happens, the companies in the organized space can easily double or triple their turnover. So this happened with many other sectors, shift from unorganized to organized, and there's no reason why it shouldn't happen in this sector also. The IT company is also a great business. So as we like in IT, it's a scalable business model, not capex intensive. You can grow the business rapidly without much of capital required. You throw free cash flow, you have decent margins, you have a decent moat. And the common factor between all these IPOs that we are discussing is that they are offering a good blend of growth as well as value. So I'm not overpaying in any of these names that we have recently invested. So we are pretty cautious about that. That market is at the high. At the same time, we should not get carried away. And my value-conscious approach towards investing stands out. So these were the opportunities that we saw. Decent companies, decent growth at a decent price, and that's what the common factor between all these names would be.
For both these companies, where should they trade? Is there a comparable kind of what would you be willing to pay? Or I mean, obviously you bought because you saw value, but what are fair valuations? P multiples basically for both.
Broadly, 1 to 1.5x PEG is what we look at. If the company is growing at 15-20%, we don't mind paying up to 25-30 P for that company, but not beyond that in most of the cases. So that's what the comfort zone for us would be, a PEG of 1.5.
All right. Thanks very much, Aman. A great conversation as always. Thank you very much for your time. And, absolutely take that point. Well, 170.